Hi, welcome to Accounting Play. It's John at accountingplay.com. Email me, go to the site, subscribe, get some free stuff. Today we're talking about partnerships. Flow-throughs in general, partnership being a flow-through. A flow-through structure versus a corporate tax structure. General partnership. Limited liability partnership. Limited liability company, not corporation, company, and the SMLLC, which is sole member LLC for all you single LLCs out there. So this is a really, really exciting lesson for anyone who's ever been in business, wants to be in business. Huge disclaimer from my heart is that all this stuff varies hugely depending on your independent tax situation, what you're trying to achieve. So only, the really best thing you can do, number one, educate yourself, use your Accounting Play resources, learn, and then go find yourself a good attorney and a good accountant, stick them in the same room, and make some decisions together, given your individual tax situation as well as your business goals. But know about it first, so you're not burning up the clock asking them what a flow-through entity is. These just need to be like common terms for you. So let's talk about the old partnership. Partnerships, by definition, are two or more people, entities, etc., operating together. So, hey bro, let's start a business. Yeah brah, and something is formed. Not even necessarily have a contract. So, starting the partnership, two people. Now, multiple people can be, but we'll just say partnership 50-50. Partnership taxation is incredibly complicated, and a lot of this business structure has to do with taxation, also what you're trying to accomplish with the business. So this is a very informal business structure, which in some ways is an advantage, but in a lot of ways it's a huge disadvantage. So once you just start operating, that's how it goes. Huge disadvantage is unlimited liability, right? Issues of continuity of ownership at the end. Low cost, but really, if your partner messes something up and you're held personally liable, that is a horrific situation. So that's not something that's an honest and viable business operation. However, I've seen it personally as a CPA as maybe two members informally operating some property and other various holdings. So it's still a very relevant structure. And this 50-50, just to give you an idea, let's say there's a revenue of 100, well, I'd call it $1 million revenue. You have expenses at 300, 700,000. If this is just a partnership 50-50, how that would split down the middle would simply be 350 and 350. Now, on a tax return, USA, this would be delivered via a K-1. So what's happening here? A separate return is being filed, so you do have a separate return, which is reporting this stuff, and the result is coming to the shareholder on a K-1. This act of coming from the partnership to the shareholder, think of this as water. It is flow through, okay? Flow through. So, on a flow-through entity, the profit or loss will go to, in the case of individual shareholders, individuals, Now, in the case of businesses, if a larger business, different business structure owns a partnership structure, those K1s will flow in. So something even that I've seen that would be pretty abstract is a private foundation, right? Charitable intentions, let's say, giving money away, and they are also partners in investment partnerships. And so a charity can get a K1, a trust can get a K1, a trust can actually push out a K1. So we're going to talk a little bit about flow-through entities in general. And so all this flow-through stuff and good old Merca has to do from activity via partnership. So the partnership, a general partnership, has all these disadvantages like the liability issues, continuity of ownership issues. But we're talking about partnerships in general now because I want to explain a little bit more technical nature of the entity that I don't get to go into in the app accounting flashcards or the Android version or even on the site in my writing, but I feel like my tax background is really relevant. So if you get a K1, you might know a little bit more about it. Certainly won't be an expert, but know how to ask some intelligent questions. So these flow-through entities can be a partnership, regular, and it can also be a limited liability partnership, okay? This would probably be, by law, some sort of accounting or professional services firm, right? So we won't really talk too much about this, but we will like to talk about the LLC, okay? The LLC is a limited liability company, not corporation, please. Limited liability company. LLCs, under the partnership law, have the ability to have a lot of different owners, as does partnerships, a lot of great advantages there, and have these flow-through properties. Now, on these structures, on this K1, you can have different allocations. One for profit, one for loss, and one for capital. And these actually appear on a K1. I refer to the K1 in the tax structure because that is going to be, the annual compliance filing, the tax associated, and this profit, loss, and capital that's appearing on the form K1 is memorializing what has happened on the partnership level as it now relates to the individual partner and flows into the tax return. Now, an LLC, you could have thousands and thousands and thousands of partners, like a large oil investment partnership, something like that. Now, another LLC might be 10 people, a small software development company, something like that. And so within this fun house of things, people can have different profit allocations, loss allocations, and capital. Generally speaking, you see that these things are all equal. However, capital is essentially ownership, so you can have more of a passive investor that's not assigned a profit or a loss portion, and these theoretically can be different, although I have rarely seen that. And so on this K1, as I was explaining, it's going to flow through the activity to the partnership level. And that activity might be ordinary income in one income category, it might be interest, it might be dividends, it might be capital gains, it might be a specific kind of loss called 179 deduction taken from the business. It's going to have lots and lots of different income classifications, which makes things all a bit more complicated. And this ordinary income, depending if it's an individual shareholder, may be subject to self-employment tax, or it may not, right? Now, if there's a loss, it may or may not be deductible in the current tax year. So there's a lot of different, maybe yes, maybe no. Partners are not receiving wages and W-2s. They're receiving guaranteed payments, okay? So this is how people can have a partnership, and maybe someone working on the front ground on the onset, or otherwise can be guaranteed a certain amount of payments every month. These would be guaranteed payments. Otherwise, it's going to be divided on those lines one way or the other of profit, loss, and capital. So this is a little overarching introduction on the tax side and this concept of flow through. No double taxation with the partnership at all. After, we are going to cover the corporation and how that differs from the partnership. Continuing this lesson, actually continuation of what we were just talking about. Flow through versus corporation. We're also going to be continuing on with going a little bit more in depth on some of these entities. The GP General Partnership, Limited Liability Company, and the SM LLC, which is the Single Member Limited Liability Company. As we were discussing, the flow-through entity is going to flow through to the individual, or it is going to be flowed through to a corp. Let's say a corporation owns sub-LLCs, right? Publicly traded company, big solar company owns a ton of different LLCs for different projects. You know, maybe this is actually even a foundation. So the key here is that the tax is coming through the individual corporate foundation. It's coming to the partner. Now, C Corporation, we got them C Corp Island, right? Maybe it's the Caymans, we don't know. But this C Corp, the profits, are subject to tax. Now, we're going to go into a lot of depth with the corporations at a later time, but just know that this is subject to tax, and then to get actual payment to the shareholders is going to require a dividend, which is also going to have some kind of tax on some level. So you get the benefit of being able to raise a lot of capital, public company possibilities, but double taxation. That is the general difference. Also, to arrive at the profit, you can first deduct wages, which is really important. So a lot of compensation comes out in form of wages, which in that case would be a deduction to the corporation and then tax at the lower level. Touched upon the general partnership structure, pretty much a nightmare because you might be personally liable for things. Talked a little bit about that these are all flow-through entities, that being the LLC, General Partnership. We're also going to have the Limited Liability Partnership. But basically, people are going to have an LLC to limit liability, right? And people are also going to use an SMLLC to also limited liability. If you're a sole member limited liability company, which is an interesting structure to touch upon, as an individual, federal government, they consider disregarded. And so this will be reported on your individual tax return. On the state level, if it's California, it might require a separate return. It might require a hefty fee. All these structures are going to have fees on local activity, such as the LLC fee for California. Okay. Now, also in the flow-through entity that we did not discuss so far, and is not discussed in the accounting flashcards lesson, is the S Corp. So the S Corp is a corporation, and it's also a flow-through, and has its own very specific properties that I will go over in another lesson. But know that the S Corp also flow-throughs on a K1, but the big disadvantages are the investors are limited, typically no foreign types of investors, somewhere in the range of 100 or so. I'm not getting technical, talk to an attorney. Anyway, also in the S Corp, its divisions of profit, loss, and whatever else, profit, loss, and capital, is, let's say, 30, 30, 40, will all be split on those lines. And they're very firm and rigid versus this other partnership structure. You can adjust the profit, loss, and capital as the activity gets split between different shareholders. LLC is kind of like a fund house. Of any partnership structures are kind of like fund houses. We were going over some of the ways we could divide things. So let's just say you have a 1/3, 1/3, 1/3. You have your partnership tax return, which gets filed. And so on that, you have the total profit of $90K. You have $900 of interest, and then you have some different guaranteed payments. You have guaranteed payments. So if we're split across the middle in the form of a K1, 30K across the middle, interest would get reported separately across the middle, and then these guaranteed payments could be anything. This could be the head partner or the general, and this guy may be lady, man, woman, child, who cares, $50,000. Maybe this person gets none, maybe this person gets 100. And these are all going into the individual, in this case, return. Or if it's a different structure, it's going to be flowing into the entity return. Let's talk some practicalities of what I've seen with these structures and some of the advantages. If it's just some individual starting out, forgetting about all the state fees, a lot of the sole member LLCs is kind of a nice way to go because it's going to provide some liability protection. It's going to have a little bit less costs associated versus some other ones. It's not going to require another tax return. You have the S Corp, which flows through, but a lot more rigid. So this is mostly for like an individual person typically, or family members, and so this is really bad for like stock option stuff. It's all possible but complicated. Sole member LLC, like I said, it's really good for that. There's a lot of LLCs for investment purposes, investment structures, like hedge funds, I would say. Structures such as a hedge fund, and then C Corp Island, which has the double taxation issues. C Corp. A lot of people are gonna, big startup idea, gonna get rich, public companies, arguably the most costly structure. Always be aware of the state and local fees, which can be significant. General partnerships, I think people rarely enter into them. I was thinking of a husband and wife that are in a band together. That's a general partnership that I have seen, and that might make sense for them because they're married anyway. But nothing is without risk. S Corp, much more rigid. General LLC, super flexible all over. S Corp also requires wages paid. Typically, definitely wages coming out of here, but double taxation on the C Corp side. So next lesson, we're going to dive heads deep into the C Corp, but wanted to mention some of these flow-through structures, which include an S Corp. S Corp, you can also have a little bit of payroll savings, depending if you qualify for it, also known as kind of like a loophole, so that can be another thing, can be very good. But all of these structures have costs and benefits. Practically speaking, talk to people who are already in the business. If you're trying to raise a big seed round, the attorney's probably going to have some default Delaware C Corp structure. But if you're seeking funding, you can ask, say, what is your preferred business structure? Is it okay if I go out and do it my own, or do you have your own in-house attorney? Sniff around, talk to people who've done it before, been successful. When you're looking for tax preparation, ask. Because just because someone's a CPA doesn't mean they prepare a lot of LLCs necessarily. They might have all individual clients. You could have an EA, which is an enrolled agent, prepare the tax return. That might be an expert at LLCs, or just a general preparer that's really good at C Corps for whatever reason. So when talking to lawyers, how many business entity structures do you do a year? What type? Could you give me some examples? And same with the CPA. Continue to educate yourself on these various components and understand your business structure so you can take maximum benefit of deductions and be sure you're operating so that maybe you can limit some of your liability using your proper insurance as a first line of defense against problems. Thank you.